Being a business owner gives you more control over your money, but it makes getting a mortgage harder. Traditional lenders often don't understand entrepreneurial income, which leads to denials and overpriced loans. Not because you can't afford it, but because the system isn't built for you. If you don't understand how to navigate mortgage options as a business owner, you could be stuck paying more, getting rejected, or leaving money on the table. I'm Andrew Russell, owner and founder of RCG Mortgage, and I specialize in working with entrepreneurs and business owners. So God forbid they get a big fat no when it comes to mortgage time, we get them a big fat yes, because who doesn't love a big fat yes? Take my client Andrew. That's right, he had the same name as your boy. Andrew was a successful drop shipper, and he was making about $20,000 a month net. But turns out his accountant was a little expense happy, which were all viable, of course, and that $240,000 a year of revenue was written down to about $60,000 for the year. So that's $60,000 divided by 12, it's about $5,000 a month. Now, it turns out Andrew wanted to buy himself a nice house, and $5,000 a month just didn't cut it. So he didn't know where to go, what to do. He kept getting denied over and over again. It turns out his realtor finally referred him to our team, and we actually looked at his income a different way. So over the last 12 months, he averaged about $20,000 a month in deposits. So instead of using his tax returns and going off $5,000 a month, or that $60,000 for the year, that $20,000 instantly, we can use half of it, which is $10,000. So we basically doubled his purchasing power just by using his bank statements versus going off of his tax returns. But I can hear you now, hey Andrew, tax returns, that's what we have to use, right? And mine are jacked. No, there's all these cool alternate programs. There's bank statements, there's profit and loss, there's 1099. In the case of Andrew specifically, we use his bank statements. And I could say, hey, Andrew, I hear you saying it right now. You got it, right? It's W-2s. That's what they look at. W-2s, tax returns. No, it's 1099 specifically. It's maybe your bank statements. There's investor loans that go off the market rent. There's more product out there that doesn't require a W-2. And of course, here come the haters from left field. I'm sure you gave your boy Andrew the same name, your namesake, a higher interest rate, right? No, the case is for these loans, the interest rates are actually very similar to conventional mortgage rates. Now, of course, there's been ups and downs. These mortgage programs came out before the pandemic, and then during the pandemic, during the COVID crisis, of course, they disappeared. They went away. And then they came back, and say the market rate after COVID was a little bit high, say 7.5%. These programs started in the mid 8s, 9s, maybe even 10s, just because the market, secondary market didn't know how they were going to perform, or people are going to want these type of loans. Are they going to pay them on time? So that's been a couple years, of course. And now the interest rates on these programs are usually the same, maybe a quarter higher, or sometimes they're even lower, because turns out self-employed clients putting 20% down or more with great credit take a lot of pride in ownership, and they pay their mortgage on time very typically. All right, guys, let's go over, if you're self-employed, number one, how you get paid. You could be a C Corp, an S Corp, an LLC, a sole proprietor. So what does that look like? Not everybody who's self-employed and entrepreneur understands how they're paid, how they're taxed, all that good stuff. So let's go over that together, number one. And then based on how you're paid, let's see all the different mortgage types and which one would make sense for you, depending on all the different circumstances, if you qualify for plan A, B, C, or D. We'll go over 4 different options. All right, so if you are self-employed, you could be a sole proprietor. You could be a S Corp. You can be a C Corp, right? You could be a partnership. There's tons of different options. We're never going to necessarily hit them all, but all of these specifically are taxed in different ways. Sole proprietor is typically a Schedule C, right? S Corp, sometimes this gives you a K1, or actually it gives you a K1, and sometimes even a W-2, which we'll go over. C Corp, these do not flow over to your personal returns. So sometimes banks don't even realize you have a C Corp. And this is reviewed differently than the other corps, so that's the thing. Partnerships, of course, there's a lot that goes into it, what percent you own of the partnership. So, from these, it depends. Number one, we always want to see how long has the business been in existence, right? So it was open January 1st of 2020. So that means it's open over 5 years. 5 years is a sweet spot for conventional loans often, and we'll go into the reason why. Otherwise, typically, lenders want to see your business open for 2 years. Now, it's a lot of gray area with this, but usually it's from the date of formation of your various corps. So in other words, if you opened Russell LLC. We would go off of the exact date that it's open. Typically, this is what we look at. So for instance, if it opened 03 of 2023, right now filming this, it's actually summer-ish of 2025, right? So that would be 2+ years. But if you opened it January of 2024, it technically, even though it looks like it's 2 calendar years, right? 2024, 2025. By the time it hit the summer of 2025, it's less than, right? So 2 years. The corp is less than 2 years. So because of that, there are some lenders that are actually okay with using this income. It gets a little bit more dicey. But just as a general macro overview, you want the business to be open for at least 2 years. 5 years is a sweet spot. So again, what do you get paid? Are you W-2? Are you 1099? If so, how's that flow into a Schedule C, or does it flow into a S Corp potentially? Is there a K-1? Is there a distribution taken? There's a lot of stuff, and this is what us mortgage guys have to go over to see what you qualify for. All right, so you're self-employed. That's how you get paid. Now, you say, hey, Andrew, I want to buy myself $1 million house. Well, guess what? My job is to finish this video and keep your attention, but of course, it's get you that $1 million house. So again, just to go over a rough scenario, $1 million sale price. Say you're self-employed and you put 20% down, which is $200K. That's an $800K loan. So an $800K loan, just roughly, guys, using a rate of 7%. It wouldn't be cool by the time you watch this consistently, rates keep getting lower, and like, Andrew, rates are 4%. What do you mean 7%? Well, guess what, folks? Right now, it's 7%, and that really stinks. So just roughly, again, for information purposes only, about $5,600 a month for the principal and interest. So you figure $1 million house, taxes per year are probably going to be somewhere around $15K, right? Taxes per year. Let's say, I don't know, $3,000 per year for HOI, right? So you have another $1,250, you have another $250 taxes for insurance. So that's going to be $7,100, right? I'm not using ChatGPT here. Imagine that. I'm old school on it, folks. So $7,100 a month all in for taxes and insurance. This is what it would look like on this type of property. So how do we get there if you're self-employed? All right, so if you're self-employed, guys, we deploy, we call it a 1, 2, 3 strategy. We're actually going to add a fourth today with my favorite color. That's right, folks, blue. Pretty sure you could have figured that one out. So with that said, you have option 1, you have a conventional mortgage. Option 2, you're going to do a potential, which we're adding to the fold, a 1099 program, super cool. Option 3, bank statement program. Option 4, P&L. So this one is either Fannie typically or Freddie, right? Conventional mortgage, usually the best interest rates. These 3 are going to be non-QM. So a conventional mortgage. So the big thing here is going to be, and there's a lot of factors, right? What's your average credit score? Typically if you're putting 20% down or more, they want about a 680. Something there would be good. You can actually do less. You can get away with a 620 or higher. Pricing is a little bit spicy. So typically 680 or above, you get a great deal. If your business is open, remember we said, guys, 5 years? So they made this uniform. It's funny. You have Fannie and you have Freddie. Fannie Mae, Freddie Mac. They're pretty much the same thing, but they're not. Figure that one out, on separate covers. So they each had different guidelines, but it's still a conventional mortgage. They've actually made uniform that if your business is open 5 or more years, we only have to look at 1 year. So for instance, if this is now 2025, we would just look at your filed 2024 taxes. And if you're on extension for the previous year of that, just the 1 year, 2023. So it helps because sometimes if your business income, say 2023, your business income, what you showed as a net, is higher than 2024. It's a huge no-no in the self-employed income space. They don't want to see your income actually going down, especially over 20%. A lot of questions are asked. So this will go off the 1 year average, but if the average of your profit, which is very difficult, guys, again, you have your W-2 potentially, your Schedule C, an S Corp, your K-1s. If the profit, so you take like the K-1, or we go off of the W-2 income. In a Schedule C, we don't go off the 1099 on a conventional loan. We're going to go off of the net profit on a Schedule C. If that's enough to qualify. Now, what would it take to qualify for this? Let's assume a credit score of 740, guys. Let's assume no debt. Now, of course, is this viable? Does everybody have a 740? Does everyone have no debt? It just makes this example a little bit cleaner. Of course, it always makes sense to consult with your loan officer if it's not the basic of a high credit score and no debt. But if that's the case, $7,100 a month tax and insurance. If you have great credit, you could probably get away with like a $14,500 a month income, which is like give or take 180. So like for instance, 180 a year net would qualify for this. So what does that mean? If we do a 1-year average for conventional, if we look at 2024, if you add 2024's W-2 income, right? So the W-2, and then say there was a S corp. So follow me. You're a 100% business owner. You have an S corp. You give yourself a W-2 every year. Your accountant says so, and you have a net profit, which goes on to a K-1, which of course pulls onto your personal returns. So 180. Say you gave yourself, in this case, an 80K W-2, and your K-1 is 100K. There you go. 100 plus 80, 180, you would actually qualify for this. Now, I've looked at thousands and thousands and thousands. That was like a good Disney song, right? Thousands and thousands and thousands of tax returns. And people typically do not show that. There are W-2s where people show maybe a 60 or an 80K, maybe an $120,000 W-2. But then showing profit on the K-1, typically there's a lot of expenses the business has that you're legally able to write off and lower your taxable liability. Because remember, guys, that K-1 pulls over to your personal return and you pay tax on that. So what they do, you write off your revenue, write off the revenue with expenses. So your net profit of that 100 went away. If we went like this, and it was just 80. 80 is about 66, 67 a month, right? So it's about a 30-ish mortgage payment, max allowance, not even close to 7,100. You wouldn't qualify. So you need that K-1, but in actuality, do I see these? I really don't, guys, just to be honest. So that's the first option. If you're self-employed, of course. Option A, we always go conventional loan, typically better interest rates, a 1-year average if your business is open 5 or more years. But does this happen in actuality? Typically, no. Second option, 1099. So if you're a real estate agent or you work for a company, but you don't get a W-2, you get a 1099. And say it's like a clean 2 years, meaning, what do I mean by that? So your 1099, let's bring it over here. In 2023 and 2024. Let's say in 2023, you made $200,000 on your 1099. Let's say 2024, you made $210,000. So we can actually, on the 1099 program, now we're getting out of conventional land, we're going into non-QM land. Again, 20% down. Interest rate on this is probably going to be close to the conventional rate, maybe a quarter higher, not all that big of a difference, but we can go off of 90% of this 1099, which is cool. This never existed. Typically, if you had a 1099, who cares? Because 1099 is basically cash. So we would look at your Schedule C or your corporation, we should look at the net profit, and typically 1099s are always written off. Now, with these new programs, pretty cool, we can use 90% of that. So instead of $200,000, we give you credit for $180 for the year, and we give you credit for, what was that, like $180 again and change, a little bit more. So that's about $15,000 a month, which is what we needed, right? So there you go. So for instance, to qualify for this property, $1 million, 20% down, give or take this scenario, if your 1099 was $200 for 23 and $210 for 2024, because of the new amazing non-QM programs for 1099, 10% off the top, we use 90%, 10% expense factor for 1099 income, you would actually qualify. And that's a 1099 program. But what if you don't get a 1099? What if you have a business, it generates revenue, and it goes into a bank statement? A business bank statement is what will work off specifically. So same concept. Say you have a business, and this business generates, let's say, $500,000 a year in revenue, just in revenue. So now we'll bring this one over here, our bank statement program. So let's work off of $500,000. So again, you're an entrepreneur, you're self-employed, you're a business owner. You have a business, revenue, not expenses, not profit. It brings in $500,000 a year in revenue, which is a top number in your tax return. And as a business owner, like, hey, how much are you getting each month in deposits? So if you're 100%, we have to know what percent owner you are. So we're going to work off of 100% owner. So 100% owner, that's about $40,000 a month in deposits. So we base income off of, right out of the gate, 50% of that. They use a 50% expense factor. Now, side note, you can use more of that $40K with a CPA letter saying your expense factor, the amount of expenses versus your revenue, is less than half. So sometimes I've seen 10% expense factor, 20, 30, 40. The likelihood of your business, if you're a self-employed business owner, having only 10% in expense is very low, meaning like it's not very typical. So 50% is very aggressive in my opinion, but you can get that right out of the gate with no issues. So then this brings down to a $20,000 income. So again, $500,000 in revenue, $40,000 a month in deposits. We give you credit for half of that for income. So again, if you remember, this example had $15,000 a month income, but you have to show all this money, right, in K1 and all that stuff. If you remove the K1, just have the W-2, you don't qualify. The P&L program, $15,000 a month based on this information. This program, $20,000 a month in income, which again, assuming amazing credit, no debt, that gives allowance for a $10,000 mortgage payment. This is $7,100. Again, now you qualify with the bank statement program. Just as easy as that. Now, last but not least, now this bank statement program is typically priced similarly to a 1099. Usually it's not a big variance. The P&L program, there is a bit of a variance. Let's swing this puppy over here. So it's a little bit higher. Say, hey, Andrew, why would I ever use the P&L program? Well, what if your bank statements, what if they're all over the place? What if you're seasonal? What if you've had some volatility, but you still, if you add it all together over the last 12 months, you've made a lot in revenue. But what if it's all over the place? The lender's underwriting team might be concerned that your revenue stream is super volatile and inconsistent. So you know what doesn't look at your bank statements? Is a P&L, right? So P&L is basically, let's just say it is June of 2025. So if we say June of 24 to May of 2025. In these 12 months, the business brought in, to this example, $500,000. In the last 12 months, maybe the expenses are heavy towards the end of the year. So in the last 12 months, the business had $250,000 in expenses. Now, a P&L, if you think about it, it's just an Excel, guys. I'm sure you guys know what Excel is, right? Think in your head in Excel on the top is a revenue number, call it $500,000 in the last 12 months. The business brought in revenue. Then think of your expenses. You probably have potentially cars, travel, meals, entertainment, employees, labor costs, maybe attorney costs, you never know, right? So this shows a net gain of $250,000 for the 12 months, which is about $20,000 for the year. So it's the same thing. That $20,000 for the year, assuming again, great credit, no debt, this gives an allowance for a $10,000 mortgage payment again. So as you can see, the P&L program, although this is going to price a little bit higher than the bank statement program, just because we're not really looking at much, it's just an actual profit and loss document, it's not bank statements. If there's inconsistencies as a business owner, not all businesses are every month. In this case, $40,000 a month in revenue, $40,000, $40,000. Not every business has that. Maybe it's a business that's open for Easter and Christmas pictures. I've seen those sprout up over the last handful of years, almost decade, where there's a couple places they do Christmas pictures with Santa and Easter pictures with the Easter Bunny. But they do it for like 3 months because they're so busy. But 3 months and then 3 months again is 6 months. What happens the other 6 months? Nothing. There's no revenue coming in. So then an underwriter might be concerned with that. So instead of looking at deposit, nothing, deposit, nothing, 12-month run with 2-3 month periods with nothing. If you have a P&L that just shows right here, $500 for the year, $250 in expenses over 12 months, this is the net profit. It's a cleaner illustration and presentation of your income as a self-employed or entrepreneur, business owner. But again, rates on this are typically 1/4 to 0.5% higher. Guys, do me a favor. Go in our description, click the link, our self-employed buyer's guide, because you might be a physician with your own practice. Maybe you do Botox on the side. Maybe you do drop shipping, whatever you do for a living. I don't know, maybe you're an influencer. Whatever you do for a living, there's a lot that goes into this. Now, of course, I know what I'm doing. This is what I do for a living, but it's not what you do for a living. So make sure you go in the description, click the link, download the free guide. It's going to guide you through this whole process and make it simple. Make sure, guys, you watch my next video that talks about self-employed purchasers. Are you picking the right mortgage? It's called Self-Employed. Are you picking the right mortgage type for your income? It's going to go into what type of income you receive, what does it take to qualify, and make sure that you avoid all the landmines for the purchasing process so you can get in the home of your dreams. Make sure you click it, guys, and check it out.